if your model before was just raising a lot of money and throwing that money on every type of business scaling problem, it definitely has become harder.
One thing is to grow and one thing is to double revenue.
Pulling the tech lever as an angle of growth is just one of the hardest things you can actually do. Focus on profit, be patient, and do the hard things.
Okay. So, hi everybody. Welcome to the first episode of The Tech Factor. My name is Julian. I'm the founder and CEO of Tech Miners. We execute product and tech due diligence with both depth and speed for investors and ventures. And as of today, we've helped over 120 technology companies and their investors to scale with confidence, building proprietary software along the way. But that's exactly our topic today. We want to talk about exactly that, scaling those companies. So, the situations where we get called in is normally like about you want to make some tech company significantly bigger, and there's questions around that. Lately, you see in the news and magazines, there's all this talk about the downturn in that type of company. So the dropping valuations and the tech company layoffs are continuing. There's famous examples, the former superstars of European tech ventures like Klarna, who saw his valuation slashed by almost 80%, or also the notorious Gorillas, the 10-minute commerce venture that is supposedly, or according to the rumors, in talks with the competition to buy them up, and the CEO already planning his next step. So it seems that the good old days of growth at all costs are over. So scaling tech companies is not just pouring in more marketing and seeing what happens. So there's people with a different opinion as well. I mean, we have our perspective as well as somebody who's seeing quite a lot of things in the market, but that's going to be the topic of today. So growing a business is never easy, that's the given, but what makes it especially challenging when talking about tech companies as opposed to scaling a brick and mortar business, for example? And for this specific topic, I have a guest with me today that can certainly provide an informed view on this, as he is, over the period that we've been knowing each other for the last 10 years, he's literally, I've seen him do it all. So he successfully founded and scaled exited ventures in the classified space, where I used to be as well. He then transitioned to a VC investor type of role, but already hanging on to companies that are, let's say, beyond product market fit. And then he started to lead his own private equity fund, which he's doing today, called Flex Capital. They invest into mature software companies from the new German Mittelstand, if you like, which they dub the Mittelstand over at Flex. And yeah, I'm super to have you here today, Christoph.
Pleasure, Julian. Hi. Thanks for having me.
Hi, well, welcome to the Tech Factor and the first episode. You have the honor of opening this with me. So let's dive straight into the topic. You've heard the introduction. In your opinion, do you think it has become harder to scale those tech companies in the current environment?
I mean, basically, if your model before was really just raising a lot of money and throwing that money on every type of business scaling problem, it definitely has become harder, right? But if your model is really building a company from scratch, really looking first for product market fit, really giving it some time, then I guess the time has become better, because I guess for 70-80% of the cost base of every tech venture is related to people. And it's become easier to get the good people behind a strong vision, which is built for the long term.
So if I hear you right, it would just be quality has changed, right? So people who know how to scale without endless dollars have a slight advantage right now and can probably also convince the necessary talent a bit faster. So do you think that something has changed for the investors as well on the side of, let's say, scaling ventures and helping out? Do you see anything that has changed for them apart from what we just mentioned for the ventures?
Yeah, so I mean, it's pretty important to distinguish at which kind of investor you're actually looking at, right? So I'd make up three buckets. Let's say there's the early stage, the venture investor, then there's the growth investor, then there's the buyout funds. I'd say for everybody who's investing in money-losing businesses, a lot has changed. Right? Sometimes to the positive, looking at new opportunities, because valuations came down significantly, but also they have to look at their current portfolio, have to think hard about how you slash the burn. So for them, a lot has changed. But let's say also for the buyout funds, something has changed because we typically always looked at businesses that are money winners, so that are earning money. And suddenly that is the new fashion again. So everybody is now looking for companies who are earning money, and that's increasing demand for those businesses. And so for those businesses, prices are at least stable, if not growing. So there has been a lot of change, but sometimes in directions you wouldn't figure at first.
Okay, so that's something we've seen before, like in the Corona times, for example, we've seen PE investors or typical buyout bucket guys that you just mentioned flocking into what you would rather call growth, right? So there was some downward mobility in terms of stage, but what you just described would go the other way. So you would say somebody who acted like a later stage VC now might be tempted to get into opportunities as well that are more of the buyout stage. Would that be correct?
Well, actually, currently we don't see VC funds coming into the buyout space, at least not in Germany. I for sure can't speak for the US market. Those funds there are oftentimes more like crossover funds. And if you have the crossover mandate from your LPs, I definitely imagine that those funds are looking stronger on the EBITDA strong businesses.
Okay. So for any, let's say, company leaders looking to raise money, it might be a good advice to open the horizon a bit and not go just for the typical buyout investors or growth investors, so also broaden their view a bit. Maybe make an example, so to get you located in those, can you maybe say how do you find your investment opportunities and how do you assess if they fit with your strategy in that specific bucket or where you can actually support?
Yes. I mean, we as Flex are really focused on the DACH market, so German-speaking Europe, and our core specialty is really the bootstrap companies, so companies that haven't had any investor to date or have at least shown a very, very capital efficient approach to growth. And those companies usually don't come to your doorsteps, you have to approach them. So either we approach them directly or some M&A banker, some M&A advisor shows us those opportunities. Sometimes it's coming out of our own network, but the two biggest channels by far is really approaching them directly or having good relationships to bankers.
Okay. Would you say that has been your focus before the focus on profitability and let's say on the operational efficiency or capital efficiency was placed by the recent start of the crisis, but that has been your specialty before, right? This is not something you do because out of this current situation, but it has been your focus from the very beginning of the first fund, right?
Yes, I mean, and the personal background goes back to 2008. So in 2008, I started directly out of university, Absolventa, an online job board for graduates. And with that business, we directly started to raise some 1.5 million in seed money, burned that in just the first year, then went back to investors, asked them for more. And they said, for good reasons, you get nothing here. And then we had to really cut back stuff from 30 to 10 and really bootstrap our way back up. And that was a very, very valuable experience for me because with all that money and back in 2008, 1.5 million was a lot of money. And we really burned that quickly and really tried to solve problems by just throwing money at them. And afterwards, we really had to focus on our customers and really give things time. And for the first 1 to 3 years, customers always told us, I mean, guys, we're not going to buy from you. But if you are around, like in the third, the fourth, the fifth years, then we might start a relationship. That's of course a very frustrating experience at but in the end it becomes true. So after 3 to 4 to 5 years and really tweaking your product, we really managed to grow a very healthy business. And in the end, with 120 people, a very profitable business, strongly growing, sold to a large publishing house. So my personal experience really is if you take the time and put in the effort to really build something out of your own cash flow, the likelihood is much greater to become a healthy business that's built for the long run. And those companies are exactly the companies we're looking for at Flex.
Okay, that's interesting. So would you say one of the things you have to do to scale the companies you're looking at is to make them a bit more aggressive than they would normally be? Because those, I've been bootstrapping a company myself as well, and you turn every dollar and you think about what is the one thing I have to get right and no few errors allowed. So do you have to push them a bit to be more aggressive or think more in terms of size and scaling quickly instead of sustainably? But because I mean, there's a certain trade-off, right?
I mean, that's exactly what we're trying to do when we buy bootstrap businesses and take them to the next level. Keep in mind, those have just been owned by the founders, and it oftentimes took them like 5 or 10 or 15 years to really get to that level. And they've been very, very focused on risk because it was just their own money on the line. And so, especially in those type of situations, we feel that it's a very, very good idea to de-risk the founder, so put some 5, 10, 50 million just in his pockets, and then really talk about scaling and really pulling every lever in the growth lever box. And so I think in the early days of a business, there's a lot of value by just focusing on efficient growth. But after some time, if you need to go from, let's say, from 5 million revenues to 10 to 20, 30, I mean, then it's important to really push down the gas pedal, right?
So I understand that the element of letting them take some money off the table, and also a significant chunk that might just well be enough to let this be your last opportunity, is a major factor in getting the bravery out to actually think about like hardcore scaling, right? One thing is to grow and one thing is to double revenue, but if you're talking going from 5 to 20, that's like a major task, right? So they need the basic security, you say, so that they can actually believe in that this is the right thing to do, because otherwise they would be more conservative. Okay. Maybe let's go into like a plastic example of what's the last investment you did and why did you pick them? Can you talk about an exemplary deal you did lately?
Yes, I mean, the last business we were allowed, I must say, to acquire 51% in was ComX.io. And ComX.io is actually a sales enablement, sales automation software. And those guys have been purely bootstrapped. So it's 3 founders. And in their 4th year, they are surpassing the 20 million in ARR. And this business is extremely profitable. And so that was a very interesting business for us. However, I mean, there was, of course, a lot of private equity interest in this business, but a lot of other PE guys shied away from it because despite the strong financial profile, they have some operational challenges. So productizing things that are currently done by service, some of their customers are churning, right? And those challenges we are really thrilled by, really look deep, and once we get the confidence derived from our own entrepreneurial experience to really help them, we try to bond with the founders and really develop a partnership here. What is also really fascinating for us was the mindset of the founders. I mean, getting to beyond 20 million in ARR in just 4 years with extreme profits. Some other founders might have their nose way up, but those guys especially are very humble, very, very mission driven, and they are well aware of their skills and strengths, but also know that they lack something to really scale the business from 20 million ARR to beyond 100 million. And so it was that combination of the strong and humble and aware founder team, the financial profile, and frankly speaking, I mean, sales enablement, sales automation software, there are a lot of buyers, right? So given our investment horizon, which is 3 to 5 years, we see that we can really help the founder reach the next level quickly and then go together for the big exit.
Okay. So your focus on operational support was what made you confident that you are the right guy to help them overcome those challenges as well. So what I understand is that it's not just about, okay, we know this can be automated and we just need to build the right tech to do it, but it's rather like we're still figuring out whether there's a sensible way of automating this. And then you would probably decide, like, do we have to build our own tech or can it actually be done with like off the shelf stuff, right? But this is not a poor, let's say, technology dependent scaling question. So it's cold hard operations saying like, can we actually do this with less people or none at all, right?
Yeah. Well, I mean, you just mentioned the focus and the confidence to really solve operational challenges is what I guess still in the private equity world is pretty much under development, at least in Germany, right? So in the US, you see big funds who really run like software holdings with huge operational stuff. And that's what we're trying to look at. So if you look at our first business we bought out of the first Flex fund, it was a QR code software business from Bielefeld. And when we entered, the guys had a 40% churn rate, right? And usually other e-funds tell their analysts, if you see something beyond 10% churn rate, just don't look. So it's probably trash. Huh? I'd say in most cases, they are right. A high churn rate is really a problem. But we really do always our own DD, really dig deep. And sometimes we see things, okay, that's fixable, right? And in the special case, it was they just had a payment problem. They were charging globally customers in 150 countries, and they all charged them in euros. And so we just had to switch to Stripe, charge local currencies, do of course some other stuff, but with that we brought down churn in just 2 years from 40% to 12, and
Okay.
that resulted in a big exit, which resulted of course in the founders that at first just sold us 60%, kept 40, and out of the 40 in the second big exit, they just sold half. But just that tiny portion, the second exit, made them much more money than with their initial sale. And that's kind of our promise to founders, to de-risk first and then go for the big exit. The we call it the second bite of the apple should be bigger than the first one.
Okay. That's very interesting. If you would frame this negatively, you say, hey, they overlooked a really easy lever. Doesn't that at some point, if you find too much stuff you could directly change operationally, doesn't that undermine your trust in the management team? So if you find too much stuff that's easily fixable in some weeks due diligence that guys during years of operations and bootstrapping didn't figure out, doesn't that somehow give you like the chills?
No, I mean, most of the time it's just a question of focus. Because look, I mean, we're looking at bootstrap companies who reached, let's say, 7-8 million in ARR, and at the same time show they're growing and they show profits, and they did all that just off their own cash flow. So those are strong founders. But even with a high churn rate, they managed to come to that level because they had to focus on other stuff first. And so we really talk a lot to the founders and understand why they did kind of like overlook the churn aspect. Usually they didn't overlook it. They saw that, but they focused on other stuff first. Like in the bootstrap phase, in the early days, that's perfectly fine.
I would probably underwrite that. The next thing I just thought about is like, okay, the way PE funds tell their analysts to use customer churn or customer behavior, maybe even action with customers if they get some interviews, as a proxy for validating the product. I always find this quite interesting, right? So people just tell me TechDD is not top of our mind. And I think I heard similar statements from you. So obviously you focus on other types of support, not necessarily fixing the tech, but then investors take customer behavior as a proxy for judging product quality. Do you think that's like industry standard, or do you say there's different approaches to this and there's people going much more into the details? So I'm just curious about that churn number, for example. Would you take this as an indicator for product quality, or did that make you think about any additional tech questions, or was it churn that was purely motivated by currency issues and stuff like that? How do you get to the idea about whether tech is a problem or not? I mean, that's always really interesting for me.
Well, I think it's at first important to distinguish between product and product market fit, the technology behind that product. And what's really important for us, and where churn is oftentimes in the indicator, does the product really solve a problem for the customer? Did you target it to the right customer audience? But not so much on the quality of the code and the scalability of the technology behind it. And if I ever say technology is not our one core issue, I mean, of course, always we do tech TD with all external providers for our deals. Because, I mean, if you miss something here, if the tech is totally outdated and you can add on features on such an old code base, you might have some ideas what you should do, but you are just not able because you have to remanufacture the whole thing upfront, and that might take you 3 or 4 years. And given your investment period of 3 to 5 years, your investment period is over before the product is ready to really add on features. So I guess scalability of the tech and an up-to-date tech stack is our issue, right? I think why the PE guys don't focus on it is they just don't understand it. And look, we have all software entrepreneurial backgrounds, and we're one of the very few funds in Germany that have that in the PE space. Most of the other guys are like consultants or investment bankers, and for them it's just a cost item or line item stuff. And so I think oftentimes they don't look at it because they say, okay, I mean, obviously the product as of today can deliver. That's why we see a growing business. That's my feeling.
Yeah, I mean, there's different flavors, right? So if we say like they just don't understand it, it's not a bad thing. So on the surface, there's an attribution error that's easy to make. On the surface, many things look like a sales problem or like a marketing problem or like a pure operations problem. But once you get to the first derivative, you normally end up with something where you at least have to ask tech what is going on there and what's up and what did we do in that respect, right? So normally once digging down, you quite quickly arrive at tech explanations for sales problems, for example, or you couldn't conquer this and that segment of the market because you were not able to add on features. So on the other hand, there's also buyout funds that literally tell us, you give like a 5 to 6 grade in German schooling system. So that would be at the very low end of the scale. That's exactly the businesses we're looking for. As long as the customer base is stable and there's not too much churn, then our interpretation of that thing is there's client knowledge poured into software. This is what we see in this company. We don't see the most attractive tech stack that's going to win awards. It's maybe even difficult to find talent for that specific stack or that way of implementing solution, but we believe in that the knowledge is spot on about the product, about what customers want. And we see technology just as a residual problem of getting that knowledge out in the right way. So there's even people looking for tech stacks that, well, nothing should be added for the next years, but it should just be cleaning up because that's what they know how to do. But it depends on the buyer profile as well.
Well, I mean, in the end, pulling the tech lever as an angle of growth is just one of the hardest things you can actually do. There are so many things before that are much easier, but sometimes you just have to do it. And I can give you one example. We just last year bought two companies in the ERP software space. One was the market leader, or one is the market leader for audiologists ERP software, and the other one for opticians software. And those are two segments who are really, really closely tied. And one is already a pure SaaS player, was founded as a SaaS product, and the other one was founded in the 80s and is the leader for optician software and is just on-prem. Formerly owned by a holding, they never invested anything in product, right? And in this special case, we really united the product teams and really are building a totally new product that's really overarching to this whole segment. But our product roadmap lasts until 2027. So that's a very, very long game we're playing here. And it really took us some thought, and there have to be a lot of preconditions to really be able and willing to play the long game here. I mean, in this case, there are roughly 13,000 independent opticians and audiologists, and we already today own more than half of the market. So we are up and away the market leader, and so we can take the time to really build something better here. But I feel those are very rare situations in the classical buyout context.
Yeah, because I mean, you take on some additional risk, right? Culture risk, if you like. If you have two companies with diametrically opposing cultures, probably one didn't even consider product something to invest in, and obviously it was not even a problem, and the other guys were product centric and building on a modern stack. So when you say we joined the product teams and made them work together, that sounds like an interesting challenge to help as an investor as well, because you have to mediate somehow, right? Or that's where we can develop the value of helping that new combined company, right?
Yes. But frankly speaking, in such a scenario, I mean, we've been done it as entrepreneurs before from the commercial and the product angle. But for the tech angle, we always work together with external specialists to really get that thing right, because it's so important. If you are up to a 6-7 year journey, you have to get the starting point right. And I think it's an easy decision to make. Apply an expert here who really can point you in the right direction.
All right. Cool. I have one question here from the community, from the listeners, and I'd actually transfer it to you because it's directed to you as well. It says, "Hi, Christoph, what are your key investment criteria and what would you consider a deal breaker?" So that's interesting.
Yeah. I mean, we're frankly speaking, in a way, centered around the financial performance of the business. So we look at companies that show at least 1 million euros in EBITDA, at least 5 million euros in revenue, and we need to see a healthy growth trajectory. And again, we much like an efficient way to growth. It can be slower, right? But it must be efficient. And of course, team is for us as well very, very important. What would be a deal breaker? I mean, a deal breaker for us is if a team tells us we're strong in Germany, and now we just have to scale to, let's say, France and England, and we just copy our blueprint. Or I've got a team of 3 salespeople, and that's working out nicely, and now I just scale it to 30 people, right? So one word is really underestimating the challenges that come with scaling a business. I mean, that would be a deal breaker if owners, if management teams don't have awareness for that severity of a challenge.
Okay, so it would be like a too lighthearted or overly optimistic team, or at least what you call in Germany lazy to think about. You say, yeah, we're just going to internationalize and not even think about what would that mean in terms of taxes. So this could block your whole team for half a year to find out what's going on with selling all over Europe. So because we had a bit of the same situation, when I started my first venture, it was also, we just take the Belgian copy and paste approach, and it's just going to...
I remember.
Yeah, but it's like in the beginning, if you really, especially when you came out of the consulting context, like it was with me back in the day, you got the big goggles on, right? So you look at the opportunity, and even though you've been doing due diligence for clients as a consultant, all of a sudden, because you want the opportunity so much, you have to remind yourself all the time, am I having the goggles on right now? Am I like not asking the questions that would need to be asked? So what do my future co-founders know in terms of marketing? Will that be enough for the target market I'm looking at? So I know it has been enough for Belgium, but will it be enough for Germany, where there's a 700-pound gorilla in the room that has marketing budget you will never have? I know exactly what you mean. So that is interesting. Other deal breakers you saw where you say it wasn't necessarily the unrealistic view of the situation of the founders, but something else?
I think a pretty obvious one is if you get pitched with a plan and in the course of the process, the actual numbers don't meet the plan. That's always the red flag. I mean, they say, okay, in 2022, I'm going to make 10 euros in revenue, and then you end up with 8. So that doesn't give you trust that really that they can grow according to a predefined plan.
Okay, so you pretty much stick with the plan that they present you, right? So it's not that you make your own plan on where this can grow, but you would expect them to have a credible plan and back this up with delivery on previous plans or from previous periods. That's it?
I mean, we always, of course, do our own plan, but if a founder is confident and thoughtful about his plan, and he can explain why he's missing something here, that's a red flag for sure. But oftentimes, frankly, with those bootstrap companies, they don't even have a plan.
Yeah.
So they've been always cash flow positive, and we together developed the plan. So that's also a situation that's, I'd say, pretty unique to our way of doing PE.
Yeah, I mean, that's also a good way of getting to know each other and seeing what can the other party really help me in. So doing like a workshop style of developing the plan together, we see that quite a lot, especially with the PE clients. We'll say, okay, we're going to see how the interaction is in the first test and to see what each party can bring to the table, where their vision exactly lands for the next years and stuff. Okay. We have another question here that is referring to something you mentioned before, and it basically says, what do you mean by efficient growth? I think you mentioned capital efficiency, but maybe you have like a bit of a larger concept around that.
I mean, our basic concept is easy, just using little money for good growth. And I mean, if you grew your business quickly to 5, 7, 8, 10 million euros in ARR, and you just took 500,000, I'd still consider that as an efficient way to growth. But if you pour hundreds of millions into business and your loss numbers are surpassing your revenue numbers, that's definitely not something we'd consider, and that's currently out of fashion, I guess.
Okay. Is it with that efficient growth topic, isn't it also something you have to get them out of afterwards? I mean, it's a bit of the same topic we had before, but if somebody for reasons of efficiency was doing stuff that he as a manager, founder of a sizable team shouldn't do anymore, but efficiency is somehow yielded by, let's say, neglecting the power of management or the steering a team of senior people instead of doing something your own. Did you have any of those situations where they're trying to be overly efficient and you just can't get it out of their mindset?
I mean, if you look at our overall portfolio from first fund, so there are five platforms, and they are growing on average like 55% and showing a 34% EBITDA margin. So those are all growing and profitable businesses. So once we win, it's not like we throw the efficiency thing overboard and just focus on growth. I mean, sometimes the founders are a little bit too shy, and we say, okay, if your Google Ads budget is working with a 200,000 monthly budget perfectly and with amazing numbers, I mean, let's do 400 and then 600 and then a million. And sometimes then the founders say, okay, it just doesn't feel right if we do a million because a million sounds so much. And then we say, okay, if a million is working, it's not much. We can just do it. And the other thing that the founders sometimes feel, okay, now I'm de-risked. I mean, especially if they take from the table like 20 million or 30 million, and that's enough for their generation and maybe the next generation. They say, okay, now let's go for the very big thing and lose focus on the efficiency. And that's something we don't do. So once the founder says, okay, let's send things in parallel and put some money here and put some money there, we especially don't think that that's a good match to the previous DNA of this very business, because they are used to growing efficiently. And if you suddenly switch that thing to just squandering money, I think that won't work.
I mean, it's difficult. You'll have resistance in the organization as well, because if they over years have been trained to do just the opposite, okay, that's what I get. Other questions from the community. I have one here that said, like, what are the challenges for scaling a company that never get old? So the oldies but goldies, so the stuff you would tell your junior analyst to look for if he sees any patterns that point towards that stuff.
Oh, that's a hard question. There are many obvious things, I guess, around team composition stuff. And I think generally I was always hoping that someday things get in a way of smooth sailing, right? That someday I'll surpass that milestone and the next milestone, the next, and afterwards I just overlook the business and lay back basically. But that never happened. So after the next milestone, there comes the next and the next and the next. And so things in general keep being hard, right? So that's my core thing. It's not really getting easy. And the second is there are no easy industries. Sometimes you're in your own industry and everything looks like painful and hard. And you look to your friend who's also an entrepreneur and that looks so easy. But that's oftentimes just because you don't know the industry there. And so that's what I'd consider my two basic truths. So there are no easy industries and things keep on being harder. And you just have to deal with it and really get motivated by the next challenge.
Okay, so it wouldn't be like archetypical challenges, but rather like the recognition of the fact that the challenges are never going to end. You can't tell which ones are going to be thrown at you, but you need to see the spirit of like, yeah, I'm here to solve them, whatever it is, right? Okay, interesting. Let's see. We have another question here that is referring to the current environment. It says investors are slowing down in writing checks and therefore investments are being done pickier, which I would probably, from our point of view, would underwrite somehow. So now investors can choose among basically a bigger portfolio of opportunities and they're a bit pickier on where to put their focus. In general, I think that good teams still get, so there's not like, oh, they're picky and all of a sudden you're not good enough. If you're a good team and you have a case along the lines which Christoph described, you're always going to have investors interested. I think it's all gotten a bit slower and pickier, but for the people who perform well, few things changed. For all the others that stick out due to their operational efficiencies and that maybe need to push it a little bit more, what would you tell them how to stick out? If it's not by, oh, wow, what a dream case, I definitely want to get in. If you're not able to get that type of feeling with all the investors you talk to, how would you try to stick out?
I mean, my personal view is if you can show that you can really earn money, that's always in fashion. And if you're not yet there, then you at least have to show a very, very convincing path to profitability and quickly, not in 4 or 5 years. Sometimes you're just unlucky. You pick the business that needs a lot of investment up front, and it's a tough time for those businesses. But oftentimes you just have to be creative, right? You just have to be creative and give things time. And it's not like you were out there and found the business, and after 2 years you do the big exit. So most of the businesses we see, they're around for 10 years, 15 years, 20 years, and then someday you do the big exit. So focus on profit, be patient, and do the hard things.
Okay. Would you say that there's another question here that we expert have like when it comes to scaling and making the company bigger, have like an inherent advantage? So if somebody from the industry obviously has some inherent product knowledge, about what to build in that industry, do you think there's also an advantage in terms of, hey, I've seen other people in the industry scale their companies, or I know what it takes to grow, I know what it takes to get bigger? Is there an element of that as well?
Yes, for sure. I mean,
Yeah.
if you experience, if you have special knowledge in one industry, that helps a lot, of course. But on the other hand, frankly speaking, sometimes you need to be kind of like green behind the ears to really just start the business. Because if you knew what it takes before, you just wouldn't start it and keep your old job.
Probably the daunting prospect of having to fight your way through that industry would probably make you step away from the opportunity. Okay. I think that was interesting. We have no more community questions. Anything else you want to talk about, Christoph?
No, I think you have a very broad spectrum here. I hope I could be of some help.
Yeah,
Thanks
of
a lot.
course. I always find your perspectives very interesting. Yeah, but this has also been our first episode here, so we've tried to keep the topics a bit broader than we would maybe normally do as somebody who's focused on tech all day. So we have like a natural bias to see tech even where it's maybe not as important as we would like to be. So for some investment cases, it's just a minor factor, and we try to be a bit broader here today. That's why I brought such a wide-ranging range of questions to ask. Very insightful. I think we learned a lot of what it takes at scaling companies at a later stage where there's actually money being made, and the only question is how can we make more of this and how can we get this to the next level of profitability. And also your perspective as an investor who has an experience as an entrepreneur before, I found that very insightful, and thank you for your time.
Thanks a lot.
So to everyone else, there's the obligatory thing you have to do at the end of videos. So if you want to follow Tech Miners on LinkedIn, there's certainly a button for that. There will be more live events. So I have some other close collaborators and companions from the past lined up to get onto other topics as well, apart from scaling profitable companies. We have those speakers coming out. Just check on the page for the announcement of the new events. It's going to be more or less monthly. The format will be called the Tech Factor, like this one. And thanks everybody for taking the time and listening. Thank you, Christoph, for your time.
Thanks a lot.
Take care. Bye-bye.